Hello and welcome to this week's US Stock Market Report. I'm Gillham, the Chief Analyst here at Wealth Within. This week I'll be talking about investing in exchange-traded funds, or ETFs as they're known, versus investing directly into individual stocks. I'm also going to cover the Dow Jones and this week's stocks of interest. Now, this week's topic is based on a question posted by Ramit, and I briefly answered this in last week's report, but I thought it warrants much more of an in-depth look, and so I thought I'd cover it more fully in this video. So if you have topics that you would like me to cover, let me know, or if you'd simply just like to ask a question like Ramit did, please be sure to put your question or subject in the comment section below this video. If you're a regular to this channel, welcome back, and if you're just joining us for the first time, let me extend a big welcome to you. Now, I'm sure you'll gain some great insights and some inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Also, before I get into the report, click the like button just below now. All done? Great. So let's get into this week's report. Prior to the global financial crisis, or GFC, there was a significant surge in mutual funds due in part to the introduction of employee-directed retirement accounts and the introduction of new products and the buoyant markets in the late 80s and 90s when mutual funds hit record highs. However, investors started to question the value of these instruments given that many funds tended to achieve very mediocre returns over any 10-year period. Now, following the GFC is where the big reality check occurred, as many investors became even more disillusioned by the institutional funds, and since then we've seen a significant surge in exchange-traded funds listing on the stock exchanges around the world as a way for the financial services industry to continue to attract money into the market. The rise in ETFs came about because investors were seeking greater transparency and control over their investments following the fallout from the GFC. They also wanted a simpler way to invest that allowed them to diversify their risk at a lower cost. But many investors have again started to question the value of investing in a managed fund through an ETF. So is investing in ETFs better than directly into individual stocks? Now, to answer that properly, let's take a look at what you need to consider when investing in each of these investments. An ETF is a listed managed fund that trades on the stock exchange just like individual stocks. ETFs provide investors with access to different asset classes such as stocks, commodities, bonds, debt, or currencies. Similar to an unlisted mutual fund, an equity ETF, for example, can be exposed to hundreds of shares, which endeavours to replicate the performance of a specific index or benchmark, such as the S&P 500 index. Although depending on the asset class, ETFs may benchmark a currency such as the US dollar or a commodity such as gold. So in simple terms, they are pretty much the same thing as what investors were using prior to the GFC. Now, a major consideration for most investors when investing in the stock market is the associated costs of the investment. Consequently, one of the so-called benefits of investing in an ETF is that it provides investors with access to the market at a lower cost than many traditional mutual funds. ETFs are also priced more efficiently to the value of the assets in the fund, as they typically operate with an arbitrage mechanism that assists in keeping the share price in line with the value of the underlying assets. Whilst these attributes make ETFs an attractive proposition, investors are still exposed to the same risks that led them to jump ship from managed funds during and after the GFC. That's because investors are still subjected to the fluctuations of the market, given that ETFs have to remain fully invested regardless of whether the market is rising or falling. And while some would argue that an investor can sell out of an ETF at any time, the unfortunate reality is that most don't sell assets that are falling in value for fear of losing. Remember, the goal of an ETF is to track an index or benchmark. But similar to the issue with unlisted managed funds, many investors are paying for the privilege of achieving average to below average returns. So let's look at an example. Looking at the screen right now, if we review the iShares Core S&P 500 ETF, you will notice that this fund has tended to underperform the index after management fees. Whilst not disclosed on the screen, if you review their product disclosure statement or PDS, it states that these returns do not reflect the transaction costs investors pay to buy and sell ETF securities in the fund. Okay, so what does that really mean? Quite simply, if these costs were factored in, the returns would be lower than what is actually presented. What is even more interesting is that the ETF receives dividends from holding the underlying securities in the fund, which forms part of their total return. Yet the index which they are benchmarking themselves against does not include distributions from dividends. If it did, then the performance of the benchmark would be considerably higher. The reality is that many investors are happy to turn over their savings to professionals in the hope of achieving better returns than they could on their own. But as this example demonstrates, this is not always the case. So, are you better off investing in individual stocks or ETFs? For those of you who follow my philosophy, you will know that I favour investing in individual stocks, but only if you're prepared to gain at least some knowledge to protect your investments. That's because the number one reason why the majority of investors fail in the stock market is due to a lack of knowledge about how the market works and how to manage risk. According to the financial services industry, one of the major benefits of investing in an ETF is that you can achieve greater diversification than if you invested directly yourself. But as I've previously demonstrated many times, this results in a fund holding up to 100 different stocks or more, which not only increases the risk of the portfolio, but dilutes investment returns, condemning you to investing mediocrity. Think about it, you don't get twice the benefit from holding 20 stocks than you do from holding 10, and you certainly don't get 10 times the benefit from holding 100 stocks rather than 10. Given this, it seems unrealistic to justify why fund managers would continue holding so many stocks when the diversification is so small. Unfortunately, the myth surrounding diversification, or what I like to call diversification, is one of the main reasons why investors have to accept lower returns. Because whilst it's true that diversification reduces risk, a portfolio of shares that is over-diversified is exposed almost exclusively to market risk, which cannot be eliminated by diversification. That's a really important point. The truth of the matter is that a well-diversified portfolio that allows you to achieve maximum diversification and minimum risk only requires between 5 and 12 stocks in a portfolio. For those of you who read my latest book, Accelerate Your Wealth, It's Your Money, Your Choice, you know that I outline in the book why this strategy achieves far better returns and does so at lower risk. In fact, I trade a portfolio of the top 20 stocks on the Dow Jones over a 10-year period from the 2nd of January 2007 to take into account the effect of the global financial crisis through to the 31st of December 2016. And I do this using some very simple trading techniques such as a trend line and stop loss. Now, some of you may be surprised to learn that the gain achieved from the capital growth and dividends was 450.36%, or an averaged annual return of 45.04% over the 10-year period. Now remember, that includes the large fall in the GFC. This equates to an annual compounded rate of return of 18.59%, which I'm sure you'll agree is much better than having your money in a fund. Indeed, many investors have been questioning the conventional wisdom of over-diversification, preferring instead to invest in a concentrated portfolio like I show people how to do in my latest book. The reality is that most investors just want to achieve a good, safe return on their investments and a no-holds-barred approach to doing so. Quite simply, this is why many are taking a more active role in their own wealth creation strategies and investing directly. So my advice to you is that you should take the time to investigate if direct investing is far better for you. Indeed, the choices and benefits of investing directly in individual stocks that are available to the small investor far outweigh the lower returns offered by ETFs and mutual funds, which is why I strongly encourage you to read my book, as it will change how you view the market. More importantly, it will give you the knowledge and tools to change your investments so that you get better returns. Now let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Okay, hasn't the market been looking really interesting the past few weeks? It's been quite bullish, the Dow, over the last 4 or 5 weeks, and I still think it's going to continue to go on. Although that said, I think we may have a couple of 1 or 2 down weeks. It has been a really interesting market. Now we've got some news. Now we've got settled down into February. Now the Christmas sort of period's gone over. Volumes are back into the market properly. Looking at your screen is a weekly bar chart of the Dow Jones Index, and you can see here how the low happened in December at 21,712, but since then it's gone just like a rocket. So we've had 1, 2, 3, 4, 5 weeks up. Now if I use my little trusty tool, and we can see, put it down to the bottom, we look there at one stage last week, the market or the Dow was up 16% since that low, closing at around 15.5% since that low. So that's pretty good in terms of a nice run, and obviously most of that was during January. Now I am expecting a downward move. Now if I go into my tools and I just put some drawing tools, where is it? This is sort of what I'm expecting. We've seen that moving up to that point. What I'm expecting is a bit of a move down or a retest somewhere of that low over the next couple of weeks. So maybe 1, 2 weeks down. The least amount that it falls in dollar terms, the better, or it implies it's more bullish in terms of where it's likely to go. So we may see a move down then, click on that, and then move up through to the, eventually keep moving through to this year. And if I get my pointer right, and I think it's not going to work. There we go. I'll just delete it. I couldn't get my pointer to work properly. But as I said, what I'm thinking is a move up, move down from 1, 2 weeks, maybe 3 weeks, but probably more like 1 or 2 weeks. Don't be surprised if we see sort of an inside bar this week and then a down bar next week and then a move through. Now, remembering we're looking at the Dow, we've seen, here's our big high that we did back in October there at 26,951, and we're getting pretty close to that. So it is auguring well for the market to move through that previous all-time high. If I use my price retracement tool on here, we can see here how the Dow has moved through that 61.8% level on its way to that 75% level. I don't think it's going to make it in this run up. As I said, I think we're going to see a bit of a pullback and then move through. But once it gets through that 75% level at 25,641, I think we're now looking at the Dow will make a new all-time high. Now that will probably be mid-year, maybe a little bit earlier than mid-year, but don't be surprised if it takes a few weeks to get up there. But what we need to be careful is it has run pretty hard. We need to see it steady a little bit, and that's where I see it tipping over a little bit. Just getting into the stocks to look at for this week. I didn't have anybody ask me about any US stocks this week, so please, if you want me to look at any US stocks for you, whether they're the FANG stocks or any other stocks that you want to look at, please, you do need to comment below, put some comments in there saying, hey Dale, can you look at this stock? If you've got questions, please let me know. And also, we're trying to build up in the US market, so if you are in the US and you're looking at stuff, you're saying, hey, this crazy Aussie talking about the US market, I'm really apolitical. So to me, when I'm looking at the US market, I have no biases. I'm just telling you what I think. And when I'm looking at stocks, I'm just telling you what I think. And I'll get it right most of the time, but I do need your help. Please share it with your friends, like the video, share this with your friends to say, hey, get onto this Aussie guy, he's pretty good. And that would really does help me to do more and more for you. And I am noticing more people from the US on our videos and looking at our stock, our website, wealthwithin.us. Please get onto that as well. And the more you do, the more I can help you and the more I can do. I do intend doing a live streaming show in the not too distant future in the US. I'm just starting one in Australia, which I'll start off first, cut my teeth on the Australians, use them as crash test dummies, so to speak, and then I'll start one for you people in the US. So please comment below, hit like, hit subscribe, and we can do more for you. What I want to do today, instead of looking at individual stocks as much, I wanted to show you a watch list on the US market, but I want to get into the the S&P 500. And you can see I've just got some of the big stocks on this one. With the S&P, it was up about 0.9% in the last week or two. But I want to have a look at the actual bigger end of the market. Where is it? The S&P 500. I'm just going to scroll down to wherever that is. I'll find it somewhere. Okay, so there's the list of the S&P 500. All of this is we're talking about the watch list here, it's in percentage change. And so you can look at that and see, okay, here's the percentage change on those markets. And you can see here how Semantic, nearly 9% up there. Now, this is its yearly range through here. You can see how some of them had bigger and smaller range. Now, looking down here, Visa, Micron, Exxon Mobil up 3.6, Intel 3.4. Some Chevron up 3%. So some good stocks looking quite good there. But one day or 1 week doesn't make a trend. And what I look at is saying, what are they actually doing? Are they sustainable in their trends? So let's have a look at some of these. NetApp. Let's have a look at that one. Bring up the stock chart on that one. You can see this is a 1 day chart on this stock. I don't even know what they actually do, but looking at this, and if I drag that out, you'll see, that's a bit too far. You can see how it's had a beautiful, nice run up here, just the same as the Dow and the S&P 500, after falling quite heavily, actually. So looking at this stock, I think it's going to be finding some support. As I said, I don't even know what it's doing, but let me just put a basic tool on here. Looking at right at that, and I think this stock is looking really good at this point in time. It's quite exciting from my point of view. It fell down to that 54.50, which is pretty much right on that 50% level, which indicates to me that it's strong. It has fallen away quite heavily since that 88.08. Right now, I think it's probably going to fall over a little bit, make a higher trough. And if I put my little trend line tool on here, now, this is not really a trend line at this point in time, but that's sort of the angle of the trend. So what I'm thinking is going to come up, it'll fall over a little bit, maybe have 1 or 2 weeks down, then move up. But when it moves through this sort of angle here, that's probably when I'd be looking at buying. But that's looking really, really good. So looking at stocks, here's a short range here that it's had bigger ranges. Let's look at one of the bigger range ones. Let's look at this Arthur Gallagher and looking at the stock here. Let me change it to a weekly chart and we'll have a look. See, look at this beautiful big all-time high through there, and look at this massive bar that it's done here. It is looking quite bullish. Let me go to the monthly chart. Again, I don't know who this stock is. It's a new stock for me. I've never actually seen it before, but this is looking quite good. And like a very nice sustainable run on this stock. If I put a trend line underneath there, you can see here it's traveling beautifully up above a trend line, and I would think this would break through to its new all-time high. But let's now go and look at some of the stocks who have had the worst performance. Amazon down 5.38. WestRock. What's another one that I actually know? Target. Target was actually started in Australia, in a town where I was born, called Geelong. So Target's head office is actually here in Australia. You probably didn't know that. But it's down 2.5%. Nordstrom's down 2.3%. Macy's down 2.7%, so retail's down a little bit there. Walmart's down 2.6%. Costco down. All retail stocks. The Gap. Caterpillar down 1.6%. So let's look at one of those. That's one of the ones that have gone down with a large range. So let's look at this Cigna Corporation, and let's just have a look and see what this one's doing. And let's get into that. And we can see here it's a beautiful trending stock, isn't it? But it's had this big top here. So it doesn't look as strong to me. So we've got this big top here back in 2018 at 227 and a second top at 226. So a big double top here. And looking a little bit weak through here. So I would suggest this one will fall away. And as I said, not looking good at this point in time. So that's one where we had a slightly higher range. Let's look at one with a smaller range, like L Brands. Let's have a look at that and see what that's doing. Have a look at that. It's falling away quite heavily, or have been falling away quite heavily, but is it ready to start finding some support? Let's go to the monthly chart. Actually, that'll make it a little bit easier to see. Now, that's the whole history that we've got here. It has been falling quite heavily, as you can see there, from $100 down to $20. Now, eventually, this, if it's a good stock, it will give you some signs to say it will start rising. If I put this little tool on here, you can see here that we've got a high over there in September 2018 at 22.16. and obviously a low there at 21.78. Now, a lot of people know about support and resistance. Now, I don't use that alone to trade. A lot of people will jump in because that hit 23.71 only in December. Now, we haven't seen a big move through here yet, but I would stick this on my watch list. Don't jump too early. That's really what I'm suggesting here with this stock, is if we see a higher trough than that one, so 23.71, I'd like to see it move up, come down, make a higher low above that, and then start to move up. If we see that, that's a much safer entry into this stock. But this one I would firmly put on my watch list right now. But really, it's finding stocks to buy is not that hard. Too many people make it really hard. People look at that and go, wow, there's 500 stocks on the S&P 500. Dale, which ones do I buy? Then they spend a lot of time doing some fundamental research, some fundamental filtering. They might look at news and announcements and those sorts of things. I just look at the top 500 there, but you can actually look at just the top 30 in the Dow if you'd like to do that, or the top 20 or top 30 on the S&P 500, because it's slightly different stocks between those two, or the top 50, and you'll find trades all the time. You don't make your life simple, and when I'm teaching traders, we teach them to break it down into different sectors. So you might just pick the top 100 stocks on the S&P 500, look at those on a weekly basis, and I guarantee you'll do very well on the marketplace. I was doing some research on ETFs only last week for my article, my weekly reports on ETFs, and as you saw at the early part of this one, I was talking about ETFs, and you can see here in the report that it's so much better. If you just bought the top 10 stocks on the S&P 500, you would have outperformed any ETF in the country last year. And so you can actually do it just with some simple rules, just using like a trend line or some simple other theories that we talk about in our trading mentor course. I can teach you how to make more money than an ETF, really simple, on less than 1 hour a week, and you'll do very well, and just in our trading mentor course. So if you're looking at getting into the market, looking at trading, have a look at the course. It's wealthwithin.us. Now remember to like the video, also subscribe to it, and please help me by sharing the video, and I look forward to chatting with you next week. If you've got any questions, let me know. Take care.
What are your thoughts? If you've got any questions, please comment below. Go and listen to our Talking Wealth podcast. They're available on SoundCloud and on our website. Now they're jam-packed with valuable information which will help you elevate your trading. Now if you're serious about learning to trade the share market and you'd like more information about our courses, please click the link in the video description below. Thank you very much for watching this video. If you've liked the video, remember to subscribe to keep up to date. I'm Dale Gillham, the Chief Analyst here at Wealth Within. Goodbye, good luck and good trading.